You're listening to the Real Estate Runway podcast, powered by Quattro Capital, where we are all about alternative business and investment strategies to help you amplify life and maximize wealth. Here's your host, the recovering engineer turned multifamily investor, Chad Sutton.
All right, Real Estate Runway family. Today we have David Zapata coming back for the third recording on the Real Estate Runway podcast. He's one of the OG guests with Factum Financial, talking about the infinite banking concept and why you need to be in control of the banking function in your life, and how this will change your life is going to be shown in a couple of numerical examples. We're not talking theory and quality or qualitative things today. We are talking actual tangible examples. So if you want to go back and listen to episode 10 and episode 15 before you listen to this to reprime on what we're going to be talking about, please do so. Just scroll right up back in the show that you're looking at. Other than that, let's get right into this episode. Here's David Zapata. Here we go. All right. Welcome to another episode of the Real Estate Runway podcast. I'm your host, Chad Sutton. We are powered by Quattro Capital here at Real Estate Runway, and we have one of the OGs of Real Estate Runway here, Mr. David Zapata with Factum Financial. If you want to hear parts 1 and 2, go back and check out his episodes way back in episode 10 and episode 15. We are going to be talking about some practical applications and really the why for real estate investors behind the infinite banking concept. David, welcome to the show, brother. How have you been?
Thank you for having me. Super excited to be back. It's good to remember one of the OGs of the show. So it's good to know that you remember me now that you're famous and succeeding. And congratulations, by the way. So happy to see all the growth you're experiencing, my friend.
And likewise. I mean, we're both here because we're just trying to share the wealth. That's a mark of a good entrepreneur, is to give back and share the wealth that we all know. So David, before we get into this jam-packed, curriculum you have for us here, do you mind just give the audience a little update on you, man? What's been going on in your life since we talked like a year and a half ago?
A lot of good things. Really happy to be back. Like I said, I thought this would be very timely to come back to because of all the changes. But look, family continues to grow, responsibility continues to grow, and with that, becoming the person capable of growing through that is the most important thing. So in our company, Factum Financial, we constantly share a model for building a life of abundance. It's just not about finances. It's about your relationship with yourself, with God, with your family, with your business partners, and created abundance on that. It's been the mission for me. I continue to work on myself. I told you offline, we're closing on another property on Friday because we continue to have the education, increase our financial IQ, focus on cash flow, recognize that real estate is a way to grow in a way that brings a river of money. Like you always use that analogy. I stole that, and you don't know how many times I've shared that with people. I continue to bring that value. But that's the journey I'm in. I am obsessed with this idea of controlling the banking function because I know through my personal life, through my clients, it will bring more prosperity. It will bring more control. It will bring more guarantees for people to grow into who they want to become, which is the ultimate objective. And that's why I'm here today.
We don't usually do this early in the episode, but do you have a mic on your desk, like somewhere within the general vicinity? If you could pick it up,
I have a mic on my lapel.
Can you just pick it up, unclip it, and drop it real quick?
I fell for that one. Good one, my friend.
Took him a minute. All right, let's get right into it. We don't need to introduce David again. Go back and listen to episode 10 and episode 15 for this OG background. But let's get right into the meat of this thing and how the infinite banking concept and the intersection of controlling the banking system can really help us.
Perfect. I have a few points. I want to disclose something up front. Like, one of the things that I'm committed to do moving forward is be transparent. And one thing I've found is that the more I study, the more I practice, the more I'm a man in the arena, the more I learn, the more my perspective changes. So I thought this would be a good time to bring this conversation back to the podcast, back to the audience, because in the past, not only me, other practitioners, other folks that do infinite banking have come to the show, talked about a mindset, described the process, given a lot of intellectual ideas for you to entertain. And I think at this point, a lot of people in the real estate world and in other investment classes are experiencing a lot of pain, a lot of uncertainty, a lot of fear. And this is when people like Chad and I need to step up and bring new ideas to folks to recognize that they're still in control, they're still in power if they educate themselves and they take ownership of the processes they're engaging with the money and how money flows through their life. So that's my motivation today. I want to share a couple of bullet points. I'm not going to go into deep explanations of any specifics about IBC. What I want to do today is, if you're standing on the bridge and there's a gap between where you see real estate and where you see how money flows to you, I want to create an intersection that closes that gap so you can see how what you're doing today can be improved if you just take a few steps. And I'm really excited because I know Chad has been diving deeper and deeper and deeper into that intersection, growing his company and also understanding that getting into the business of controlling where money resides and how you deploy money is very profitable. That's why banks do it. So that's where I want to get into today. So with respect to certainty, I want to tell you, your audience one thing. Wall Street and banks have been very, very successful at creating complexity in our mind and mixing the idea that savings, investing, and speculating are the same thing. Let me say that again. They convinced us that savings, investing, and speculating are the same thing. That is why there's $7 trillion sitting in a 401k today in America. That's the reason why. And I am convinced, and I'll tell you the punchline is this: if you actually become aware of three things, you can win the money game. You're going to focus on how much you save, because a portion of everything you earn should be yours. Where you save it is the second step. You need to find a place that you own control that is full of efficiency. And number three, if you focus on cash flow like Chad doesn't stop telling you you should, then you will find a way to find freedom and live the life in your own terms. Those three things is what the wealthy, what corporations, what banks do at their level. And it's equally accessible and possible for you and I. So that's another idea. And the reason this is important is this. When you think about savings, the definition should be very clear. This is an amount of capital. This is capital deal. This is an amount of capital that I'm setting aside that I don't want to part ways with, that I cannot afford to lose. Therefore, it should have guarantees, safety. It should be in a place that I own and control. When you take the next step to an investment, now you're saying that I'm in a position where I have educated myself and I can deploy capital to seek a rate of return on that money and put it to work. And I am okay with parting away from that money for a period of time, expecting the money to return with more dollars that I deploy, right? That's the idea of an investment. Therefore, risk is present, but it's calculated and controllable. Again, just like Chad does with his company. That's a very educated approach. Speculating is what most people unfortunately do, not understanding where money is going to be deployed, not having control, not having guarantees, not having a strategy for deployment and return of that money and distributions, hoping, which hope is not a plan, that the money will come back and they'll have access to in the future. So I will plant that seed there and leave it for you to consider, because I think educating yourself about what you're doing with money that flows through you is very important, and you should have clarity of how you're deploying it, whether it's a savings vehicle, investment, and hopefully your speculations even are calculated for the level of risk that you want to take on that, seeking a higher return. So this is my first point. And I want to connect this with reality that you see all around you for your community. We all know the real estate investor that is rich in assets and have no cash flow. I don't know if you know a person like that, but I do. Millions of dollars in assets, not a lot of cash flow. And that is not a situation that is very comfortable. Okay? Think about that. The second person you know, the business owner that has a significant amount of revenue and the margins of profits are very, very small compared to the amount of money that flows through their lives. You know probably somebody that makes millions of dollars in revenue, all the money goes out of the business in expenses, and they keep $50,000 for themselves. The third most common scenario that I run into that I think is really concerning is the family that has done everything they've been told, and most of their net worth is locked in equity in their home. Their net worth is, they're millionaires, but all that net worth is attached to a property or two in the equity, and they have no access to use that money for cash flow. Those three people are people we know all around us in business, families, neighbors, yada yada. And the common theme here is that the lack of focus in cash flow has prevented them from understanding that money that flows through us as a river versus sitting on a tank waiting for one day to take cups and hopefully not running out of water before you die is the key to winning the money game. When you have money flow through you, you have access to it, you can put it back in there, is the key to how the wealthy banks and corporations do. And what do banks do? Don't do what the banks tell you to do. Do as they do. The banks are going to lay a foundation for where they put money. Surprise, life insurance policies called BOLI, bank-owned life insurance policy. The most pristine capital they compare to their risky assets. They have a foundation with guarantees, not for the return on investment, for the return of capital. Let me say that again. Every time a bank backs a policy on one of their key individuals in the company, they're not so worried about the growth. They're concerned about the return of capital in the future on that death benefit because that person eventually will die. I'll leave you with that thought because all of us quote Warren Buffett, oh, rule number one of money, don't lose money. Rule number two, don't lose any money. How many people apply that in their life? Very few, because they don't understand the rules of money. And the number one thing the banks do, again, is lay a foundation for where money is warehoused. They do not keep their profits. They do not keep their surplus with other banks or with the Fed. They keep it with insurance companies with whole life insurance policies. Number two, what do banks do? Go to any city, get off the plane, drive downtown. Who owns the best corner lots, the best corner buildings, the best real estate on any given city in the United States, probably the world? Banks. Banks focus on cash flow. They're going to acquire real estate, probably the best, most precious real estate, to add to their portfolio. Third thing they do, they create loans. They put motion into money. They accelerate money. They create velocity because they know that the more money moves, the more money will come back to them in interest. And controlling that function starts again where money resides, which is where they keep their money, whole life insurance policies. So to connect all these things that I just shared with you, I want you to think as a real estate investor. Most of you probably joined the podcast to learn about business and real estate. Think about the success cases that we all learn from. People that are well capitalized, people that have access to cash flow win in the real estate business. Why? Because they have access to capital when they need to make a down payment, right? When they need to deploy capital to create control or make an acquisition. They can deal with vacancies. They can replace a fridge, make a repair, right? They can take a property with perceived low value and use their capital, deploy capital to raise and force the appreciation of that property. Capitalization, the business of banking, is as fundamental as the business of real estate itself. So I'm here to suggest this. If you listen to one thing I'm going to say today is this. Please, if you want to succeed in the real estate business or in business in general, also get in the business of banking. Let me say that one more time. If you want to succeed in business, in real estate, please also get in the business of banking, because when you control those two functions, you're going to be unstoppable. And you're not leaking interest, you're not leaking money, you're not interrupting the power of your capital that you have set aside to control your business liquidity to a third party, to a bank. So that's my few takeaways here. One last thing, I want to the purpose of the conversation today for me mostly was share these ideas with you. I want to share with you an example. The example does not matter. I picked a random set of numbers for the value of the property. That part doesn't matter. Your audience, yourself, can teach me about this. I am a novice, right? So I'm learning about real estate through chat and all of you. But I want you to pay attention to a little simple step that changes where the money comes from. And you guys very well know the OPM, other people's money, where money comes from change the way you can not only improve the profitability of your deals. More important than that, something that doesn't show up in any financial statement is you control your risk, you control your liquidity, and you remain flexible. Those three things, to me, speak to ownership. And the purpose of getting into this business is to get away from the uncertainty that most people are experiencing in the market today, seeing their 401ks go down, have fear of retirement, have fear that in distribution time they're going to have sequencing a risk of sequencing loss. If you don't know what that is, you are not in control of how that money is capitalizing, and when you need it, it may be less than you think it is, right? You want to get in a game that you can control appreciation, that you can control the terms. I'm just asking you, please consider that if you also control the terms of how the capital is deployed and who's the banker in the transaction, you will be better off. You can ask Chad. Let me share my screen really quick and walk you through this, Chad. And I know for those that are listening in audio, you're going to want to refer back to the show notes and take a look at the video in YouTube. But we're going to walk through it. I'm going to talk you through it because the numbers are not so important. What matters is the takeaway. I want you to see what happens when you introduce a small step, when you also are in the business of banking and real estate. So,
and folks, while he's
share my
pulling
screen
up his
right now.
While he's pulling his screen up here, don't fret if you're listening in the car or something like that. Scroll down in the show notes. We're going to have a link to the quattroway.com page /podcast. Go there. You can find the YouTube channel and go back and watch this episode. Go ahead and finish listening to it because you're going to need to hear this and then see it to truly understand it. Okay. And by the way, I have to say, I think the water analogy is now yours because you've now added a water tower to it and other things like that. So well done. Keep going, brother. Preach on.
It's the hive mind. You and I make a higher mind than us individually. And to the point you made, I want to share this really quick. I suggest everyone, hopefully you can see me on camera. I'm holding my own copy of Becoming Your Own Banker by Mr. Nelson Nash. 85, 90 pages that could change radically how you think about money. I highly recommend you look this book up. If you want a copy, reach out to me. I'll send you one. I am, again, committed to sharing this message because I think it's that important. And in his book, this gentleman says this is a 10-hour course. This is not going to be an idea that comes immediately, intuitively in the first 15 minutes. I agree. Watch this multiple times. We have, in fact, a whole suite of courses and training materials if you want to get more in depth and understand how this would look like for you. I'm happy to have a conversation with any of you. But I just wanted to read one line before we get into this example. This book is not about investments of any kind. It's about how one finances the things of life, which can certainly include investments. I read that because it's always a strong reminder for me of when people go into this conversation and they think that controlling the banking function is just about acquiring a product that gives them certain return, they're missing the point. The point is where capital resides, who can control it, and how it accumulates and gets access. I want you to look at this example from the perspective of what would happen if my capital gets deployed traditionally like I normally do, and what it would happen if I introduce the infinite banking process into my transactions, regardless of the example. So let's jump right in. So I have a Truth Concepts real estate analysis calculator. All of you probably have amazing tools for analyzing real estate. I'm going to focus on a couple things, and I'll point them out as we go. So for this example, generic sample, we've shown it in many of our content videos. We have a property valued at $200,000, and we are acquiring the property at that same value, $200,000. We have closing costs. Hopefully you can see my cursor, chat.
Yeah, you're good. I'm following right with you.
Closing costs, $5,000, arbitrary again. Let's just say that that's what it is. So the total purchase price is $205,000. We're going to make sure we understand what the land value is. Why? Because we want to make sure that we can segregate for depreciation. So if we assume that the land value is $35,000, overall, our basis for depreciation is going to be $165,000. That's going to be the actual building structure. And I'm assuming that this is a commercial property, a warehouse, whatever it is. So we are going to take a loan, commercial loan for this property, and we're going to borrow $160,000. It's going to be at 20% down, 80% loan to value ratio, and that loan is going to be at 6.5%. Obviously, that was true a few weeks ago. It looks like this week that's deteriorated quite a bit, but assuming that it's a 6.5%, and we're going to do a 20-year term for 240 months, that payment comes out to be $1,193 a month. That's the context of what we're talking about. We're buying this commercial property that we're going to go and use for seeking cash flow. And we're going to add a couple things. We're going to add property taxes, $200, insurance, $200, maintenance, $50. So you can make any assumptions. We can analyze any of your deals. If you don't have a tool like this, I'd be happy to help you and show you what it would look like if you were to also control the banking function in it. The last thing is, let's talk about the income. You're going to be able to collect $2,600 in this warehouse when you rent it. Okay, so pretty good. You're buying the property total for $205. Your gross rental income is $26, so you're doing pretty good there. And then the last thing of expenses, which we all love and enjoy, income tax bracket. That individual has a 35% income tax bracket. Capital gains are going to be long-term at 15. And then whatever depreciation we charge up front that we don't deduct, we're going to have a recap tax of 25%. So this calculator is going to go month by month and calculate the difference between interest and principal, and is going to calculate the depreciation schedule monthly. So it's going to be very accurate. And then I'm going to show you a calculation for rough numbers of how we get to the rate of return we're going to calculate. So to the analysis, let's say that we're going to calculate the analysis for return in the first 5 years, 60 months, okay? And then we're going to say that because it's commercial, we're going to depreciate this property for 39 years. And then we're going to say that closing cost is 6% for realtor transactions or whatever it is. And that will give us a 20% rate of return. And if we say that the appreciation is national average, is 4%, let's just say, okay? Our total here is correct. So our total here is 27.44. So 27.44 rate of return on this property, okay? That sounds pretty awesome. That sounds pretty awesome. Now, what I want to show you is how we get to that number. This is all something that you all understand and do all day with your business. I just want to show you rough numbers, how we got there, so you can understand where I'm coming from. We're going to say that the present value here was $45,000. So 45 was our infusion of money. The 5% closing cost plus the 40% is over here. It's our total down payment. And our annual payment from a cash flow perspective, net monthly cash flow is $611. Okay, so after all the 26 that we collect and expenses, the calculator is telling us, hey, monthly cash flow is $611 for a future value of $95,332, which is called here after the 60 months in our analysis. And then after those 60 months, you'll see here that the calculation comes out to 2734. Why are they not the same? Because I explained to you this other calculator is super precise, calculating depreciation changes and yada yada. So we're trying just to get to a ballpark, okay?
And David, just to walk through what you put through here, the present value is the initial investment, cash out of pocket. The 611 is your monthly cash out of the property that you're putting in your pocket. And then the future value of 95,332, that is the sale proceeds, if you will. Correct. So I would account appreciation. It would account everything else that you would get for a net cash out if we analyze to this term. And I'm obviously being arbitrary, but you're exactly right, Chad. You're exactly right. So I wanted to get here to this baseline, right? That's what everybody in the real estate space will say. Well, this is pretty sweet. I got a great return on that capital. This is a pretty nice return on this warehouse. How could I make this better? That's the question I want you to ask yourselves. How can I make a deal like this even better? And that's when my takeaway comes to play. I want you to think, if you're a real estate investor, about also getting in the business of banking so you can control where capital comes from, how you access it, what your tax treatment is, how the loan is structured, all the things that you have a hard time dealing with banks. I want you to maybe take a portion initially, or most of it if you're capable at this point, of that function so you can improve your rates of return and you can improve how your investments perform, just like the banks do when you do a deal, okay? So how are we going to illustrate that? I want to illustrate that by saying the following. What if you had a second mortgage? And this second mortgage would represent you taking a loan
against your death benefit, against your life insurance policy. You're going to loan money from the insurance company and say, hey, I like a portion of this money in a loan that I'm going to structure. I'm going to determine how the terms work. So for illustration purposes, let's just say that you were to borrow $40,000 out of the down payment. So you're going to pay $5,000 of closing cost out of pocket cash. And the other 40 comes from a loan that you're borrowing from the insurance company, okay? The next portion of it is we're going to say that this annual loan rate is 8%. It is not what we're paying right now to the insurance companies. Loans right now are hovering around 4.25. But to illustrate the question of why would I borrow against the insurance company and have to pay them interest, I'm going to show you why. It's because you're controlling the banking function. And you should be willing to do that, because by doing so, you're avoiding interrupting the compounding on your own money and allowing that money to grow at the same time that you improve the return on a deal when you're not using your money. That's the reason why we use OPM. I'm just turbocharging that idea to the next level. And for the term, remember I said unstructured loan. How would you all like if you could set the terms of the loans you take against these insurance companies? Because you're in a position of ownership of the policy. Guess what? There's a loan provision that says that you are the individual, the loan officer of that loan, that decides how the loan will be repaid and when, in which terms, at what rate. So the company here, we're assuming, is going to charge us a base rate interest of 8%, and we're just going to match the same schedule we have for this loan, 240 months. Okay? So what has effectively happened, Chad? Our monthly loan payment on this additional second mortgage is $335, which made our total payment greater. Now it's $1,527. But look at what has happened to our rate of return, 106%. 106%. How is that possible? So I'm going to show you one more interest rate calculator, because I am curious to see what you think of this. Rough numbers again. Our present value now is $5,000, which is, again, like Chad pointed out, how much money out of pocket did I put into this deal? My annual payments, or the cash flow that comes from the property, is going to be $364 per month. We're going to make this monthly. And the future value that I can extract after 60 months in this analysis, $60,322 for 60 months. Again, not the same number, 103, 106, because we don't have the details that real estate calculator has with calculating exact depreciation monthly. But we've taken the initial deal by borrowing money from the bank only and putting the rest of the down payment from our own capital, usually sitting in a liquid account like a checking or savings account for the business, at 27% to 103%, just by introducing one small step, which is my capitalization rate. My capitalization process is going to include taking money that comes through my business, put it in a whole life insurance policy, specially designed for the purposes of the infinite banking concept. I highly recommend you go and see a practitioner, somebody that is a specialist on designing this type of policies for you, your family, your business. I'm going to put capital there, and I'm going to then use that as collateral so I can borrow funds from the insurance company to do deals, keeping more liquidity, keeping guarantees, accessing the money tax-free because it's debt. Let me say that again, accessing capital tax-free as a loan because it's debt. Very important. Using OPM. The thing that cannot show up in this calculator is the last one. I just accessed $5,000 to do the down payment from my own capital in my checking account. I borrowed the rest of the funds from the insurance company, and I have control of the same deal at a greater rate of return. But if there was more capital in this policy and I'm using less of my out-of-pocket capital, or more money in the business and I'm using less of my own capital, with the excess capital that I have compared to the initial deal, do I have less risk because I can respond better to changes in the market, vacancies, repairs, equipment replacements? Anything that can happen in a real estate that represents risk requires liquidity. And leveraging the money of the insurance company not only improves the rate of return, but improves the quality of and the risk profile of a business deal. So I wanted to show you this. I'm going to stop sharing my screen. I think that probably, hopefully, drives the point that I was trying to make. But to me, complete transparency. I'm trying to speak to audiences like this, to the real estate investment community in particular, because I feel such a strong affinity. It's something I'm doing myself. I told you I'm closing on another property on Friday. I understand now that the ability to save a significant portion of the money that flows through you is very important. I am a specialist at helping people understand that where you save your money, particularly the way that IBC proposes, is critical to control, own, and have efficiency in how money grows and flows through your life to deploy money. And the third part, which I love, again, Chad is becoming such a large voice in the community and in the country for focusing on cash flow, is the key to win the money game. So I hope that's helpful for the audience, Chad. I know that you and I have a lot of alignment in the things that I'm saying. I've heard you speak about this. I know you're getting more into it, so I'm really excited to see where you take it. We need more examples of success in our community.
I really appreciate you going through a tangible example. Quite frankly, it's hard to get one, analyzed with and without. And, if I could take a spin on it for just a second, what you illustrated there was, okay, I have a fixed amount of money. I think the amount, what was the initial amount? $35,000 that you put into the deal? $45,000. Yeah. So let's say I have that much cash and I was planning on putting that into the deal. Well, what the example we just did, that we just walked through, was, okay, well, what if instead of putting my whole $45,000 that I have in my personal bank account, instead I only put 5 and I collateralize my infinite banking whole life insurance policy, right? So I take 40 out of that. Well, in both cases, you still took 160 from a private third-party lender. So let me riddle this another way to think about it, right? Yeah. And that simply doing it that way by not using your cash and by using someone else's cash, you were now able to leverage higher than any other commercial lender would have and still maintain a relatively low risk profile and make more money on your money, right? But let me think about it this way. What if you're just a very conservative individual and you just simply don't want to use as much from a third-party lender? Even if you can't make the entire loan on the property, what if you simply said, okay, instead of taking 160,000, I'm now going to take 120,000 from that bank or that commercial lender, right? And now your leverage point might have gone from, let's say 75% to 50% or something. And those numbers are made up, but you get the point. Right. I lowered my leverage and I fill the gap and still get the equivalent leverage from using the 40,000 from my bank, my personal life insurance policy. And so, if you already had the 45,000 and you had decided to buy this property with that, you can spend it one of two ways. You can maximize your personal return on your personal dollars by using the life insurance policy's collateral or the life insurance company's capital. Excuse me, I need to talk slower. And but the other thing you could do is actually lower the leverage point and lower your overall inherent risk on the property by being the second part of the original loan. So, I mean, guys, the possibilities are endless here, but you really start to see what happens when you simply put pencil to paper.
Yeah, and I love that point that you're making. Honestly, the reason why this is called infinite, I know people dismiss that. Oh, that's just a name. There's beauty on that. There's privacy on that. You and I may think about the same thing in such different ways because of our background, our programming, our goals, our objectives. So the way you may express a deal or parenthood or whatever, travel, right? Still unique to you. How you finance that only has a few options. You can be a borrower, you can use your own capital and lose interest in the future. Or, hey, let's look at the most successful people managing money in the world, banks. What are they doing to avoid interruption, but also have access to capital through leverage? And I agree 100% with you. This gets into more philosophical discussion. I know you feel this way, but Once you're borrowing money from banks, you're also part of the problem with the fractional reserve banking, and you're tapping into all this now philosophical. So if you're somebody that's hearing me talk and you are having those thoughts about, well, I want to reduce my risk, or I really don't want to tap into money from the bank because I want to control my own capital, I don't want to be part of that situation. It's infinite how you can express this. The most important thing is that the more you capitalize, the more you'll have access to that opportunity, because the pool will be larger that you control. Bigger deals, bigger expression, more abundance. So I tell people, when you get into this concept, do not be afraid of paying premiums. Don't be afraid of capitalizing, because you are basically putting money inside a vehicle you can control now, where it's private, you access it tax-free, you're building a legacy. You heard me talk about this multiple times, Chad, but it is really important. It is really important. People see premiums and capitalizations as a cost. How long do I need to pay this for? How much is this going to cost me? Because we're so programmed to think like that. This is not fire insurance. This is not renter's insurance. This is not car insurance. The probability of all of us dying is 100%. The associated vehicle we're talking about here is a certainty. We're using that vehicle, whole life insurance policies, as a way to accumulate capital, because it's designed, that cash value is designed to grow at the end of the contract to death benefit. There's beauty in all this design. It's a vehicle that gets more efficient. It's like a plane that flies, and the more fuel it burns, the more efficient it gets. That's how this works. So
great analogy. Great analogy.
it is.
It's fat and heavy on the front,
is.
but as it burns, the fuel load drops and the plane becomes most efficient right before it's about to run out of gas, actually.
Absolutely. Absolutely. And it's the same thing here for this vehicle. The largest amount of growth will happen at year 30 and 40. Guess what? When you've been contributing to the policy, but also that's when you have the greatest deal of opportunity. So when is the best time to start considering this? Yesterday. The second one is today, or when you listen to this. So I highly recommend you consider who is controlling the banking function of your life. Could I benefit from getting more clear, whether it's my business, my family? How much are we saving? How much are we keeping? Where is that savings being warehoused? And how am I focusing on cash flow? I'll leave you with this other question, Chad. I've been sharing this question with everyone that would listen to me, and I think it's fascinating for this. If you and I were sitting in my office, and I asked you, we were looking at your financial statement, and I asked you, who do you think your financial statement says you love the most, or what do you love the most? What would you say? And I'm not asking you to answer that. It's a rhetorical question for you to think about. The relationship of how money flows through you, how you structure it, how you organize it, probably reflects the things that matter the most to you, the things that are important to you, the people that are important to you. Consider this vehicle, because it's going to give you great insight into the fact that you should love yourself significantly more every day. You should love your family, protect them, leave a legacy for the future, and you should make sure that your dollars are working and are aligned with your values and your priorities. So I hope this is helpful.
And everyone, you've heard me have multiple speakers on this topic. David now 3 times on this topic. So if you can't tell that I believe in it and I practice it, I'm just not great at explaining it. That's just why I bring the experts in here to talk about this. This is super necessary. Think of it as a more efficient storage tank. I really wish we could get, maybe you can put a suggestion into Emeritus or something like that. Can we get rid of the word premium and call it deposits or something? Because that has been the mental block for more people, is I'm paying premiums. No, you're depositing money into your own bank, right? So anyway, we'll probably have David on for the Quattro episode, number 4. We'll do that. Quattro way. Haha, see what I did there. But thanks for coming on again, David. I really appreciate it. Numbers don't lie, folks. This is a proven method. I practice it. My team practices it. David practices it. And, if you want to give your dollar 2 jobs, multiply your wealth and amplify your life in a more profound way, and reduce your risk by taking over the banking function, reach out to David. David, what is the best way for folks to get in touch with you?
Yeah, obviously, multiple ways to reach me. I'm all in social media, David Zapata. I'm sure there'll be links there on the show notes. Our website for our business is Factum Financial. I also included a link to our Intro into Infinite Banking Education course. If you want to go and access that, just make sure you visit the show notes. We constantly are putting webinars every month, deep dives into different subjects, how school funding works, the real cost of an education, building wealth with certainty, millionaire kids. We have all kinds of subjects for different interests. Real estate is a big focus, of course, for us. So make sure you follow us on social media, visit our website. Would love to have a conversation if you're interested in understanding and getting more educated about how money works.
Thank you for that, David. And folks, as always, scroll down in whatever modality you are listening to this episode. The show notes will have all of David's contact information, all of these links that we've talked about. Until next time, this has been another episode of the Real Estate Runway Podcast. Over and out.
We hope this episode was insightful and brought value to your day. If so, please be awesome and leave us a 5-star review. Find out how Team Quattro can help you at thequattroway.com. Until next time, this is the Real Estate Runway Podcast.